Most of the major indices have pulled back to what would be technically viewed by our technician Mark Newton as support. So the Nasdaq is on the support line. These are all bullish support levels. Tom Lee, one of the most respected market analysts in 2024, has just dropped a major market insight that you need to hear. According to Lee, most of the major indices have recently pulled back to what's technically known as support levels, and that's a big deal for the Nasdaq. It's sitting right on its support line, which is crucial for any potential upside. The S&P 500 has retraced 60% of its recent rally, signaling that it's poised to bounce back. Even more impressive, small caps have held above their prior highs, showing strength despite the pullback. These are all incredibly bullish signals from a technical standpoint, suggesting the market is about to make a comeback. Now here's where things get really interesting. As the market is finding its footing, it's creating a unique opportunity to scoop up undervalued stocks that could explode in value as we enter the next phase of the market rally. This pullback has set the stage for what many experts, including Tom Lee, are calling a bullish melt-up, a surge in stock prices that could see small-cap stocks leading the charge. So what does this mean for you? Now, I'm not here to sell you some flashy, unrealistic dream. I'm here to give you the real deal on 3 mega-cheap small-cap stocks that could potentially make your portfolio shine this December, but only if you're ready to do your homework and take some calculated risk. Now I know what you're thinking, small-cap stocks, cheap, doesn't that just spell trouble? And honestly, you're right to be skeptical. Small-cap stocks can be volatile, they can soar and they can crash. But that's also where the potential lies. The companies I'm about to show you, they're not just cheap for no reason. There's a lot more beneath the surface, hidden potential, undervaluation, and a few market conditions that might just be perfect for them right now. In this video, we will look into why these stocks could be poised for growth despite the risk. I'll walk you through the key factors that could make these companies stand out in December and what you need to consider before jumping in. But here's the kicker, you won't find these picks on the top of any mainstream list. They're flying under the radar, and that's exactly why they might just be worth a closer look. If you're tired of hearing the same overhyped stock recommendations that everyone else is talking about, stay tuned because today we're going off the beaten path and focusing on small-cap gems that could fly under the radar. Guys, before I proceed, please help this video to hit at least 500 likes. It shows a massive support to my channel. Now a quick heads up, this isn't a paid promotion, and I'm not here to tell you to buy anything. Always do your own research before making investment decisions. Looking for the best small-cap stocks to buy before the end of 2024? Here are 3 top shares I think are worth a close look, especially at today's prices. These small-cap stocks are on sale right now. Analysts think they merit serious attention, even from investors chasing passive income. Alright, let's kick things off with a company that you probably don't hear much about, but it could be hiding in plain sight as a small-cap opportunity. I'm talking about Renault LSNO. This is a business that operates in some pretty interesting industries, and here's the thing, their products are crucial for the everyday operations of some major sectors. We're talking about chains, gears, and couplings, the kind of equipment that keeps things like conveyor belts moving, helps drive subway trains, and even transports ore out of mines. In short, Renault makes the mechanical parts that power industries we depend on. But here's where it gets interesting. Right now, Renault shares are trading at what seems like a steep discount. They're valued at just 7.7 times their forward price-to-earnings ratio. In simple terms, this means they're really cheap compared to what they're earning. So why is that? Well, it's largely because of some uncertainties surrounding the industries they serve, manufacturing, construction, and mining. These are sectors that have faced some turbulence recently, and that's reflected in Renault's stock price. But here's the catch, even with all that uncertainty, Renault has shown impressive resilience. Despite the challenges, they've managed to increase their revenues by 0.6% in the first half of this year, and even more striking, their order intake has grown by 11%. 5% compared to last year. That's a clear signal that demand for their products is still strong and their ability to secure new orders could indicate they are on a solid growth trajectory. So while the market might be underestimating Renault right now, these numbers suggest that the stock could be undervalued, making it one to keep an eye on if you're looking for small cap opportunities. That could surprise you. Now let's dive deeper into why this company could be more than just a cheap stock and why. December might be the perfect time to take a closer look, and here's where it gets even more interesting. Renault isn't just resting on its laurels, they're actively working to improve their margins and boost profitability through some solid efficiency measures. They've been able to increase their adjusted operating profit by 4% in the first half of this year. That's a pretty impressive feat, especially when many companies are struggling with rising costs and market uncertainty. This focus on operational efficiency is a key part of Renault's strategy to stay competitive and continue growing even in challenging times. Now, I'm not going to sugarcoat it. Renault does have some debt on its balance sheet, $42.2 million of net debt to be specific, and yes, that's something investors need to keep in mind. But here's where it gets more encouraging. Despite the debt, Renault recently decided to reinstate dividends. Why is that important? Because it signals that the company's management feels confident about its cash flow and future prospects. Reintroducing dividends after a period of financial uncertainty is a strong sign that they're in control of their finances and that they believe they're on track to generate enough cash to cover their obligations and still reward shareholders. So while debt is something to keep an eye on, the fact that Renault is taking steps to improve efficiency, grow profitability, and even pay dividends tells us they're on a path to stability and growth. This could be a solid play for long-term investors who are willing to take a calculated risk. All right, let's switch gears and talk about another intriguing small-cap stock, Character Group, LSCCTT. Now, when it comes to small companies, most of them are reinvesting whatever cash they have into growth, trying to chase future profits, right? But Character Group is different. They've built a reputation for not only focusing on growth, but also returning money to their shareholders in the form of dividends. And let me tell you, that's a rare find in the small cap world. In fact, Character Group has a solid track record of paying dividends, something that analysts expect to continue well into the future. So if you're looking for a small cap stock that offers more than just potential growth, one that's also putting money back in your pocket, this could be an interesting pick. What's even more appealing is that their forward dividend yield is an eye-catching 6.8% for small cap stocks. That's a pretty generous yield, and it's one of the main reasons investors are keeping their eyes on Character right now. So while the growth story here is important, it's the combination of consistent payouts and growth potential that makes Character Group stand out. If you're looking for a stock with some stability in a volatile market, this could be a solid choice. As you can see, they've managed to keep the payout steady even during market fluctuations, which is a great sign of a company with strong financial discipline. All right, now that we've seen why Character Group's dividend history is worth considering, let's take a deeper dive into what else makes this company a potential winner in December. Now let's talk about what Character Group actually does. The company is involved in manufacturing a wide range of toys and games, and while this is great for growth, it also leaves the business a little vulnerable to shifts in consumer spending. As you can imagine, toy and game sales are highly sensitive to consumer confidence and disposable income. In fact, their most recent financials showed a slight dip in sales, down to $54.6 million in the 6 months to February, as the pressure from high inflation and tighter household budgets took its toll. But here's where things start to look more interesting, with inflation starting to moderate and the Bank of England signaling potential interest rate cuts in the coming months. The pressure on consumer spending could start to ease. This could give Character Group's sales a much boost, particularly as we head into the holiday season, when toy sales traditionally see a spike. A recovery in consumer spending could help lift their revenues and in turn push their share price back up from the recent slump it's been experiencing. And here's the kicker: the stock is currently trading at a modest forward PE ratio of 9.8 times. That means it's priced relatively cheaply, especially when compared to other small cap stocks in its sector. If the market starts to believe that consumer spending is picking back up, we could see a nice price rebound here. So with the potential for sales to bounce back and the stock trading at a reasonable valuation, Character Group could be poised for a nice rebound. If you're looking for a stock with some growth potential at a decent entry point, this is definitely one to keep an eye on. Now, let's move on to the third pick on our list, Ramones Holdings, LSRFX. This one's a bit different, as Ramdon is a pawnbroker, but it's another small cap stock With a solid history of paying dividends, in fact, this company could be a hidden gem for those looking for low-cost stocks that still provide that attractive dividend income. Ramones trades at a forward PE ratio of just 9.3 times. That's fairly cheap for a company that's been consistently profitable, but what really stands out here is their dividend yield at 4.8%. It's offering a pretty solid return for investors looking for passive income. Just to put this into perspective, the average dividend yield for FTSE 100 stocks is only 3.6%, so Ramones' yield is significantly higher, and that could be appealing if you're hunting for reliable income streams, especially in the current market. What makes Ramones interesting beyond its dividend is its position in a niche sector as a pawnbroker. Ramones benefits from demand in both retail and financial services, giving it some resilience even in uncertain times, whether people are looking to pawn valuables or exchange foreign currency. Ramdon has a steady customer base, so if you're seeking a small cap stock with a strong dividend payout and reasonable valuation, Ramones might just be one to consider. All right, that's the rundown on Ramones Holdings. Another solid under-the-radar option for your portfolio. Let's wrap up and review why these 3 small-cap stocks could be perfect additions to consider this December. Now, here's something that really makes Ramones Holdings stand out. Pawnbroking businesses like Ramones are actually thriving in this tough economic climate as the cost of living crisis continues to weigh on household budgets. More people turning to pawnbrokers to raise cash quickly, and Ramones in particular is expected to have posted record profits for the last financial year, which ended in September. What's even more exciting is that Citi brokers expect those record profits to keep coming in this year, potentially pushing Ramones to all-time highs. As people continue to feel financial pressure, businesses like Ramones are seeing strong demand for their services, whether it's pawning valuable items or exchanging currency. More people are turning to pawnbrokers for help, and that bodes well for Ramsden's future earnings. In addition to benefiting from the current economic climate, Ramones is also expanding its footprint. The company now operates 169 stores, up from 161 a year ago. This estate expansion is key because it means Ramdon is increasing its market presence and tapping into more potential customers. More locations typically translate to more revenue, which should help strengthen its bottom line. Of course, there are some risks, notably if gold prices continue their recent decline, it could impact their earnings. As a pawnbroker, Ramones is sensitive to the value of gold and precious metals, which could affect its profits if prices stay low. But overall, I think the company is in great shape. So despite the potential risk, Ramones looks like a solid small cap stock with growth potential, a strong dividend yield, and a business model that's thriving in a tough economic environment. All right, that wraps up our look at Ramones Holdings. Let's quickly recap the 3 small cap stock we've talked about today and why they could be perfect additions to your portfolio this December 1st. We have Renault LSNO, a company with a strong foothold in industries like mining and manufacturing. Despite trading at a low valuation, Renault has shown resilience with rising orders and a focus on efficiency. If you're looking for a stock with growth potential, this one's definitely worth keeping on your radar. Next up is Character Group LSCCCT. This toy and game manufacturer is a rare breed in the small cap world, offering both growth and a solid dividend yield of 6.8% with the potential for consumer spending to recover. Character is poised for a rebound, making it an attractive pick for those looking for both income and growth. Finally, Ramones Holdings LSRFX. This pawnbroker has been thriving in the current economic climate, benefiting from increased demand as people seek to raise cash, with a solid dividend yield of 4%.